Welcome to episode 53 of the Cashflow Connections podcast. The topic for today is, will rising interest rates and new development kill the self-storage market? Now, you know where I stand on self-storage, and you probably know why, but after more than 50 episodes, we still have yet to discuss the details of this asset class. As you probably know, it's one of my favorite investment vehicles right now, and I don't see that changing anytime soon for a variety of reasons. However, there have been some significant changes that have taken place in the industry that a lot of people have been asking me about. In particular, people have been concerned that rising interest rates and oncoming square footage may impact returns or make the asset class unviable as an investment. Well, I think our guest does a great job addressing these questions and much more. So we're going to talk about that today. We're also going to talk about what are the key aspects of the asset class that originally intrigued our guests about the self-storage market in general. What are some of the metrics our guest is currently looking at when it comes to buying, and what does buying criteria look like? We're also going to discuss the purchasing power and preferences of millennials. This is something that certain people can be concerned about when it comes to the self-storage asset class in particular. I think that, again, he does a great job addressing this. I think this is something we've talked about also on the program, but we have an interesting conversation about it. And we have a really important discussion about interest rates. There is a lot of misconceptions about the relationship between interest rates and real estate valuations, but more importantly, the relationship between interest rates and inflation and NOI growth, particularly NOI growth of asset classes that have monthly leases. So definitely a lot of really good content. Now, as the conversation moves forward, you will notice that our guest and I think about the investment space, debt financing, and these two asset classes very similarly. So it shouldn't be a surprise to you that we have actually done a lot of business together. In fact, he and his firm are the sponsor of our current self-storage and mobile home park offering, which is currently available for accredited investors. So if you like what you hear today and you're interested in investing with our guest, who's Ryan Smith from Elevation Capital, make sure to go to cashflowconnections.com and create an account. You will have instant access to this live offering that I'm talking about. Of course, you can contact me directly at hunterthompson@cashflowconnections.com. One thing to note, because we're pulling investors together and handling all the administration of the fund regarding our particular investors, we were able to negotiate more favorable terms for Cashflow Connections investors as opposed to going directly to the sponsor. This is incredibly rare and it's not commonly achievable, but I think both Ryan and Cashflow Connections and all the parties involved, we were really interested in developing long-term relationships. So we were able to pass this through to investors. We already have more than $9.6 million committed, more than 150 investors, which I think really shows the level of interest in these two asset classes, as well as the expertise of Elevation. So if you want to join those investors, go to cashflowconnections.com, create an account, and like I said, you'll have instant access to this investment opportunity. Either way, I know a lot of people have been waiting for us to cover this topic today, so really hope you enjoy the episode. How's it going, everyone? Our guest for today is Ryan Smith, who is the managing principal of Elevation Capital Group. Ryan has more than 15 years of extensive business experience in market evaluation, property analysis, management systems, due diligence, finance, and more. He is an affiliate's co-manage multiple investment funds, which specialize in investing in mobile home parks and self-storage, and he participates in the ownership and or management of more than 20,000 mobile home park lots. Ryan graduated from the University of Tampa with a Bachelor's of Science in Computer Science. As an athlete, he was highly recruited for both basketball and baseball and was drafted as a senior in high school by the Baltimore Orioles, and again in college by the Anaheim Angels. His ability to communicate the state of the marketplace has propelled him to be featured as a commentator along the sides of Mayor Rudy Giuliani, General Colin Powell, and other notable individuals. He's also a frequent speaker at mobile home park events and has spoken to crowds of over 10,000. And he has actually been on the podcast before. I believe it's episode 16, where we talked about mobile home parks. So Ryan, thanks again for coming back on. Really appreciate it.
You bet. Thanks for the opportunity.
So I obviously, you have an extensive background in mobile home parks. I'm really interested in talking about self-storage today, and that's the main topic. But of course, I know that your career really started focusing on mobile home parks, and then you transitioned to kind of including them both. Could you just walk us through, a little bit about your background, how you started that industry, and where you saw the opportunity in terms of including self-storage in your overall portfolio?
Yeah, absolutely. So, my start came through my family. My parents were in real estate, more single family residential fix and kind of long-term hold. So as a kid, I grew up, stripping wallpaper, doing all the stuff. I'm sure many of your listeners probably also did with their parents, but certainly that was part of my story. But that kind of changed over the years, gravitated towards more of the analytics side. I helped my dad quite extensively at a young age as a early teenager do his evaluation, his MOICs, cash on cash returns, IRRs, and really help him back into his purchase scenarios. So, take a deal and find the best way to purchase it from the end in mind or from a return standpoint. And so over many years of helping my dad do that, I finally said, you know what, I need to help my dad create a way for him to do this for himself. So I built a software program that assisted him in that process, found a market with the software program amongst other real estate investors like my parents, and made quite a bit of money, from this little fledgling software company that I started when I was a teenager. Ended up building the install base to over 140 some odd thousand or so investors that use the software at the peak. And so really I come from a standpoint of more the analytics, kind of the calculation side, but we have a history as far as my family goes in real estate. So as you mentioned, went to college, played baseball, loved sports, graduated, wanted to pursue business rather than athletics. That's debatable whether or not that was the right or wrong choice, but for me, it was definitely the right choice. So right off the bat, my wife and I started buying single family residential. We built a nice portfolio of assets using the software that I built for my dad to help do the evaluation, so on and so forth. And we aggregated a nice little portfolio of about 20 or so properties. We quickly realized it was, the single family residential approach was not that scalable. Some of you who might be listening might have gone this path before or considering this path. It's a great path, so not denigrating it by any means, but for us, it wasn't as scalable as we thought it would be. We thought once you got to 20 properties, the margin should thicken and so on and so forth. And we just didn't see it. So we started looking for a better path forward, a more scalable, efficient path forward. So we spent about, call it a year, plus or minus. And all we did is research and evaluate different asset classes in real estate while managing our business. So we looked at apartments, we looked at billboards, industrial, really the gamut, mobile home parks, self-storage facilities. And the outcome of that research that we did is we built a model for each asset class. And the thought was we put them all on the table at the end of the year, and the most compelling path forward from the standpoint of a risk-adjusted return, we would then pursue. And the two most compelling models at the end of the year were self-storage and mobile home parks. And they were interesting it's interesting to say they're similar in a lot of ways, but they're also dissimilar in ways that are complementary if you put them together, which is obviously what we've done. We've invested quite a bit in self-storage and mobile home parks. So we like each for their own unique qualities, but we actually like them together because there's, we think, some lift that occurs when you put them together. So anyway, we started buying mobile home parks, building a portfolio. And then over the years, recognizing that self-storage and what it could provide as a benefit, we started buying self-storage and kind of aggregating them together within fund vehicles. So that's the real short version.
Sure. And what really drove you towards the self-storage asset class? You mentioned the mobile home parks and self-storage really caught your eye. What was it about the self-storage asset classes that made you really interested in the space?
Yeah. So, the four things I was looking for, to go back to what I wanted out of it, we had good credit, we had a decent base of capital, but the four things, my wife and I wanted were, we wanted passive income. We wanted to generate passive, consistent income as much as we could. Although we were active in the business, we wanted to have a passive component, external of management, but we wanted consistent monthly income. We wanted capital appreciation. We wanted to be able to grow the value of our investment through the assets we're buying. So we wanted a predictable NOI path or NOI growth projection. We wanted tax benefits, which real estate generally produces. And then we wanted non-correlation. So we wanted to invest in asset classes that were with a public counterpart beta rating less than 1. So we wanted something that if the market went up and down, our investments went less up and down than the market. Obviously, not at all would be best. So the two that, like I said, produced those, or at least appeared to produce those on a risk-adjusted basis, were mobile home parks and storage. But specific to storage, what we really like is there's some difference between the two. So with storage, number one, as it pertains to NOI growth from 1998 to present, and this is, by the way, not my data, this is from S&L Financial. You can also go to Green Street. There's two firms that have a lot of data on a lot of asset classes, including self-storage. But from 1998 to present, the best performing asset class from a standpoint of same store NOI growth has been self-storage. So, from an NOI growth, just a raw horsepower from X to, point X to point Y, from 98 to present, storage has been really the winner from an NOI growth perspective. There are some differences, compared to other asset classes. So, mobile home parks in particular, a more steady rise over run. So it's more of a standard growth year over year. So in recessions, historically, 2001 to 2003, 2008 to 2010, mobile home parks have a little bit better growth trajectory during those periods. But outside of those periods, self-storage has significantly better or demonstrated significantly better NOI growth than mobile home parks have since 2010. The asset class from an NOI perspective you would have wanted to own would be self-storage, although mobile home parks have also done quite well, as you know. So one, the NOI growth perspective, what we really, really like, and we think that'll continue. There's a lot of good macro factors that we think will continue to benefit the industry going forward. The expense ratios are really low. Mobile home parks, when you look at them by comparison, apartments can be in the 60% range, expense to income ratio. Mobile home parks could be in the, call it 30 to 50% range, depending on if you own the mobile homes or if you don't own the mobile homes, and if the park's stabilized versus unstabilized. But storage, really, you can even get into the mid 20s, from a management standpoint and from an expense ratio standpoint. So low expense ratios, from a tenant base, you have real flexibility. You can change the rent monthly. It's month to month rent, which is really important. And that's a really big feature of the business, be able to move rents and push rents on a monthly basis. And we do. And that's a big one. And then our average tenant currently, and we can get to this later, stays for 2.7, right now about 2.7 years, 95 days or so. So not only do you have the flexibility of moving and pushing rents monthly, but it's actually a tenant or a duration of tenancy that's actually quite long. So you have a lot of flexibility within a long period of time for the same tenant, which is, flexibility is never a bad thing, in my opinion. In terms of CapEx, or the amount of capital you have to put back into the projects, either initially or on an ongoing basis, the two lowest asset classes that we have found are mobile home parks and storage. Self-storage requires about 4.7% as a percentage of revenue in terms of CapEx, which I think the average for all asset classes is around 8.8%. So call it roughly half of the average requirement in the form of CapEx. So that's incredibly positive. So when you take all of this together, it's really positive. But one of the things if you want to look at it, and compare it to mobile home parks, because you can get a pro and a con. Mobile home parks generally produce a little bit more income than storage, but storage produces historically a lot more equity than mobile home parks. So one of the compelling features we found in the asset class is not only is there flexibility that I described, the ability to push rents, good macro factors long term, but it also trades at typically a lower multiple than other asset classes, especially mobile home parks. So per dollar of NOI you add to the asset, if you can add a dollar of NOI to a mobile home park, it's worth, call it $15 to $17 in capitalized value. But if you add a dollar to a storage facility, it's around $20 of capitalized value. So not only is there more equity growth or back end growth historically in storage, but because the real estate is typically better, better quality real estate, better locations, and more lenders have historically liked the asset class, it makes it easier to access the equity that you're creating in the asset and return it to investors as compared to other asset classes, especially mobile home parks. So that's one other feature that we really like.
Yeah, you touched on a lot of stuff there, and I just want to circle back. The
Sure.
data that you're talking about, I'm familiar with that, looking at the negative number of quarters with negative NOI growth, for example. Mobile home parks are obviously huge there in the sense that there's not really any since about that 1995, 1998 area,
Yep.
which is pretty remarkable. But when you look on the other side of that spectrum, you got self-storage, which rental increases are basically stable during recessionary periods, but can really rip when the economy is really booming. And part of that is because when people are going through recessionary times, they're more likely to move, they're more likely to downsize, which drives demand for the self-storage product. But then when times are really good, they're more likely to buy, let's say, water toys. They're more likely to buy RVs. So you're getting kind of both ends of that spectrum. So the mobile home park business actually complements that quite well. And then another point, talking about the multiple there, just to kind of reiterate that, say it in a different way. So this is something that I got caught with during early in my career, really in an attempt to mitigate risk because I was just starting out, but just really focusing on as high a cap rate as I can get in a market that's relatively stable. I think that was my driving thesis, from a big picture. But then when you're looking at, once you have that cash flow coming in, you're really trying to build a successful portfolio. What Ryan is kind of outlining is that if you're buying properties that are in slightly more prime markets that have therefore lower cap rates or slightly more prime asset classes, the more value you can add to the NOI, the more significant that back end exit is, because the lower the cap rate, the higher the multiple is. So for every dollar you add, the more of the value that you're adding to the property. I just want to touch on that because it's an interesting paradigm shift that takes place once you are in a position to pursue, alternative investment strategies and pursue things like varying degrees of cap rates, varying exit caps.
Agreed. Yeah, well said.
So when you're looking at a typical purchase, what does your typical self-storage property look like? What's some of the metrics that you look for, the cost per square foot, the types of markets you're interested in? What are some of the metrics that are driving that purchase?
Yeah. So first off, there's really two things that we're looking for today. So generally speaking, we're buying existing assets that are operationally or not as operationally efficient as they should be. And generally we're looking, to add value over time through a couple of things. And we may get to that later on, but typically we're looking to buy an existing asset. We will occasionally develop or build, but for the existing assets, just in no particular order, we like a mix of climate controlled and non-climate controlled. So we will buy an all climate controlled building, but we generally won't pay a premium because it's all climate controlled. So we like a mix of climate controlled and non, anywhere between 1 and 4 story. So the 1 to 4 story is generally the range. In terms of, kind of cost per, let's say cap rate, right now we're in the, generally speaking, 5 to 6 cap range in terms of purchase cap. Some other figures would be, and this is when I keep saying generally, it varies by asset, by market. So
sure.
There's some variance to this, but on average, you're looking for the average, units to be 100 square feet. So if you're buying 100,000 net rentable square foot project, that's 100,000 net rentable square feet, you'd expect to be, somewhere in the 1,000 unit range. If there are more units than 1,000, that means the units on average are probably too small. And there may be some opportunity to change the mix or improve the mix, take out some walls and make some units larger. If there are fewer units than 1,000, that means they may have skewed too large, and then the mix is not optimal, and we may need to put some dividers up and repurpose. In terms of the cost per square foot, generally today we're buying at around 120 per square foot or more, but that's a rough range.
Okay, that makes sense. And actually, one of the things you mentioned earlier is kind of the interesting thing about self-storage is that it has this allure, probably through the advantage of sophisticated investors, as being a very simplistic asset class. I think people look at the structure of the business and say, okay, look, it's really straightforward. You got these little boxes, you rent them out, and because of that, the expense ratio is really low.
Right.
And there's actually some truth to that. But the interesting thing is you have a very unique combination of a very simplistic structure with a capacity to make the business extremely complicated in the sense that you can add value in a lot of ways that you normally wouldn't think of adding value to typical real estate deals. So could you touch on some of the ways you can add value to these seemingly simplistic structural buildings? Yeah.
So generally speaking, we like to focus on adding value through operations, through management, and that's kind of where our focus has always been, as building a management team and management processes that stand out and that are, I'd say excellent across all initiatives. But so as much as we can, we'd like to go in and improve the project operationally. So there are some other exceptions to that. So I'll give you a couple. So in the last year, we purchased, and I'd say we are a fund that we currently are raising through, purchased a property in Florida, in Melbourne, Florida. The property was built about 20 years ago. It's we believe a fairly moated asset, which is a key. When we buy a property, one of the first things we consider is whether or not the asset is moated or not, or has high barriers to entry, which is important for us in the space. So this property we liked the location, we liked the market, so on and so forth. But one of the opportunities we saw was just in the way that the current owner was operating it. So they had toy storage in the back, boats and RVs and kind of odds and ends stuff, which is pretty inefficient in terms of revenue per square foot. So we asked that prior to closing, another 250 some odd units be built in place of that storage, which took place. So when we put under contract, there was, call it roughly 800 units in the project. At closing, there was roughly 1,050 units in the project. So, in this case, we bought a project that was good place in the market, historically strong occupancy, good demand, so on and so forth. But at closing, we were in mid-70s occupancy because we created the vacancy through adding new units. So in terms of that project is now a year later, and I'll kind of give you a range. It's roughly 90% occupied. We've pushed rents almost, I think, some 5 times since we've acquired that project, and it's going quite well. So in that case, the 3 ways we generally like to add value is we push occupancy, which I kind of just described. We push rental rates, over time, and then we push down operating expenses. One of the ways we push rental rates is what we found is a lot of the mom and pop operators, they manage to occupancy. Their goal is occupancy. We manage to revenue. And there's a difference between those 2 points. So a lot of the times when we go to buy a property, the current owner, when they're looking to sell, they want to keep their occupancy numbers padded and consistent because they think that'll benefit them on the sales side, and it may. But what we know is when we come in, there's likely a pretty big opportunity to push the rental rates to basically manage to revenue because they've been managing the occupancy. In the delta, there's some opportunity there.
Yep, absolutely. In fact, that recently developed unit strategy, I think that's actually one of my favorite risk profiles of any investment that I've made. The reason for this is that, again, with self-storage, because of the fact that you have that potential to actually develop new units, you have the potential to convert standard units to climate-controlled units if the market demand is there. You can add that value. But when it comes to recently developed units, expanding an existing facility, I really do think that's my most preferred value-add strategy because you have in-place income that's already there. You have recently developed, let's say 2018, 2017 units, but you're not taking on the risk that goes along with construction.
Agreed.
For anyone that has dealt with construction, extensive time delays, you have challenges with contractors, workers, things go wrong all the time. If you can buy that property and then it's up to you to operationally raise rents and raise those lease up those vacant units. It's a tremendous way to add value without incurring that risk, something that developers are fine doing, but people that focus on the management side of things, I think it's quite favorable. And you mentioned Florida in there, and this is something interesting. I know Florida has received a lot of attention recently with the self-storage business. What are you looking at when it comes to supply-demand disequilibriums? And you mentioned high barrier to entry, but I'd like you to speak just briefly on the Florida market as a whole and where you see the opportunity there going forward.
Yeah, we think Florida is a good long-term market to be in. Obviously, well, maybe it's not obvious, but I'm talking to you today from Florida. I'm from Orlando. I live in Orlando and spend a lot of my time here. So I have a long history with Florida, and I think Florida is a good long-term market. There's a lot of growth here. It's a low tax state. It's drawing a lot of business in. So I think the long-term prospects for Florida are quite bright in a number of markets. And so from kind of a macro view, we really like Florida. Once you get more specific to certain markets, like maybe Orlando or Miami, or there's a litany of markets you can talk specifically about. And this is, by the way, what I'm about to say also applies to other markets like Dallas and Houston and Denver and many others. But the point is, there's a lot of new development and new storage facilities being built where people or where developers think people may one day move or populations may one day emerge. That's really not our strategy, meaning building on the peripheries of a town and building where development is going or trending. We are probably the opposite end of that. So we like to buy central to a town in a well-developed area, in an area where most of the available land has already been consumed, developed, or is operating under other purposes, which to us creates somewhat of a moat in that there's lower availability of other parcels that may be suitable to storage. So with Florida, so for example, in Melbourne, the property that I just discussed, it's in a particular location that we believe to be quite moated. There are new projects being contemplated and even developed in Melbourne, but not in a range that is competitive with our facility. So we don't mind the guys building on the periphery of the town, and it's going to be really challenging for them to build in town and make the numbers work. And so even if they do, it's to our advantage because our cost basis is likely lower than theirs.
What are some of the important underwriting assumptions you look at when you're identifying a property, trying to understand if it's going to pencil? What do those metrics look like?
Yeah, so we run a model and a pro forma on every asset that we buy. So we don't buy to a price per square foot or a cap. At the end of the day, we run a cash flow analysis to make sure that we can get to the numbers that we're looking for day one. And then more importantly, long term, what we're going to do to the property to make it better. So there's not one distinct number. It's kind of an amalgamation of much of what we've discussed. But at the end of the day, we want to look at our purchase scenario to make sure we can get a current yield that's suitable for our purposes today, but then be able to grow that over time. And then, like everything, if we think there's more predictability in the growth prospects of an asset, we may pay a little bit more. And the contrary is also true, if required. And I'll give you an example of that. In the last 2 months, we looked at a property and considered it. Ultimately, we passed because it was too pricey, but it's an asset that we would describe as a legacy asset, and by that, we mean an asset that comes to market, maybe the type of asset that comes to market once every 2-3 years out of all the packages. It's kind of a jewel to own. It's in a great location. You can't replicate it, duplicate it. It's just an incredibly noted good asset. So there was one asset we looked at recently, then they were charging $4 a foot. Okay, so when we're talking about rental rates today on the average project are, call it a dollar a foot, $1.10, $1.20. We've seen some as low as 80 cents. And this one's $4 a foot. That one, you could even, because of the market it's in, you could forecast you can forecast a path and make it work. The challenge was the premium being charged was far too high. So we ended up walking from that. But at the end of the day, it's pretty simple cash flow analysis that we're running.
Okay, it makes sense. And I actually really like that way of putting it regarding, the predictability is where the premium would come in. So the more predictable the asset's going to be, the more predictable that cash flow analysis is going to be, the more likely you are to be interested in paying a premium because it's really about the predictability of the return profile, which I think is really advantageous in terms of that perspective from an investor's perspective. Earlier you talked about how lenders really like the asset class. I believe they have self-storage facilities have the lowest default rate of any commercial real estate asset, which is fascinating, given kind of the stigma that could be associated with the property sometimes. Let's talk about the financing side of things. What are you typically looking at when it comes to loan to value, interest only period, interest rate, et cetera?
Yeah, so this is more my answer is kind of our flavor on this. So it's our take and our view. What I'll describe here is what I'm trying to say is there are other options available than what we may choose to take. That makes sense. So
absolutely,
our preference in terms of LTV, we utilize debt probably less than others might. We're okay with using some. We think too much can create unnecessary risk. But in terms of LTV, we're generally in the 55 to 65% range in any one asset. So call it 60 on average. In terms of interest rate, we're in the mid fours today. Call it as a range, I'll say 4 to 5%, depending on the asset, depending on the lender. But 4.5 is probably more accurate. We do like interest only periods and generally go for around 2 years. And that helps kind of juice initial yield for the first 2 years. So typically a 2-year IO. And then the term, we like to stagger and ladder our terms, in terms of the debt we obtain per project. So not all loans come due at the same time. But anyway, I'd say generally upwards of 10 years. So 5, 7, 10 years that we stagger, but upwards of 10 years.
Yeah, I appreciate that. And for all the listeners that have heard me talk about financing every episode for the last 55 episodes, you know why I like Ryan, because that's kind of exactly the numbers that I really like to hear, particularly the comments about staggering those principles coming to, which I really think that attention to detail when it comes to protecting yourself to the downside is really critical. Regarding interest rates, this is obviously a hot topic, investors in any asset class. How do you think this environment is going to affect the real estate market, particularly the self-storage market, when it comes to the rising interest rates?
Yeah, it's a great question. It's a crystal ball question, which is always, because we all think we have the perfect path forward and the perfect view. But I will say I don't think I have the perfect view. But I'll give you my take on what I think might happen, and then I'll also say this is also representative of the general feedback of our team, who, as experience goes, I think the newest member of the executive team our executive team on the management side of the business. The newest member joined 34 years ago. So, and there are five members, the newest of which joined the team 34 years ago. So the point is, there's a collective experience that I would say, they've seen rising interest rates, before. They've been through the S&L collapse. They've been through quite a bit. They've seen quite a lot. They were around with Volcker,
right,
and Jimmy Carter and Hyper, and they've seen quite a bit. So generally speaking, I think to boil it down to a simple question to answer, I think the most simplest question I think I can start with is, can a business pass on rising costs to the customer? I think that's the central and probably the most important question. Do you think in a particular business, should interest rates rise, which usually would happen in response to inflation? So in an inflationary period of time, rising costs, do you think a business can pass on those costs to the customer? And to me, a good business is a business that can pass on costs to the customer in those times. So both mobile home parks and storage I like, because I believe I can pass on increased costs to the end consumer. And I do think that's the case for storage. So to a degree, there are risks you have to manage as far as debt is concerned, and there's some things you have to be definitely cognizant of. But just focusing on rents, one of the benefits of inflation historically is it actually helps drive, to a degree, NOI. Because if you go back to that question, if you ask the question, can a business pass on costs? And then if the answer that you come to is yes, then if a business can pass on costs, then that would likely grow the NOI of the business, right? So that would actually be a positive prospect for the NOI growth of the business. And then to a degree, some of the heavy lifting is being done by inflation. So a lot of times when I talk to people, they'll say, well, in a rising rate environment, that's going to be bad towards, cap rates. Cap rates might rise in order to maintain a spread over borrowing costs, some level of arbitrage, which may be true. But what is often not considered is the growth in a NOI. So all things being the same, if I have an asset trading for a lower multiple of higher NOI, the net result is very little difference in terms of value in the marketplace, or I'll say less difference than what somebody would presume, as if they were looking at it as if NOI would stay the same, and the multiple or the cap rate would rise and the multiple would fall. So in all, we think the ability to grow NOI could actually be helped by inflation. And the benefit there in the long run, if you're a really long-term holder of real estate, or I'll say a potential benefit in the long run, and we are long-term owners of real estate, we like owning for the long run for this purpose, is on the backside of an inflationary, things cycle up, they cycle down. Where we are today will likely be some point in the future. When, I have no idea. But if I say it long enough, it'll happen. But at the end of the day, the backside of this market cycle is if inflation does in fact help you push NOI and push those costs onto the customer and grow your NOI for an asset, at some point in the future, if inflation then moderates again, the interesting thing is there's a Pavlovian response that you've created in the marketplace. The market is used to paying a certain rate, and generally those rates do not go down in deflationary time periods. But what does is typically cap rates. So if you're a long-term holder of real estate, you actually may have an opportunity of pocketing and capitalizing the value of that NOI growth that was partially grown through, or some of the heavy lifting may have been done through inflation, if that makes sense.
Yeah, I actually really like that comment. And it's interesting because I have focused on the other side of the other side of the same coin, but I do like your perspective on that, given the fact that it's really the NOI is also subject to that inflationary period. What I have always said is that interest rates, while they are somewhat centrally planned, they are really based on supply and demand to a certain extent. So the idea that rising interest rates means decreasing costs is just factually incorrect. It is just not the case. Or to put it another way, to think that it would be the worst time in the world to buy real estate when interest rates are low would made you have completely missed out on the opportunity that was presented in 2008 and 2009, where interest rates were incredibly low. You would assume that prices would be high when interest rates were low. But that's interesting, and I'll definitely think about that and include that more in that conversation because I think it's important. Regarding the lending environment as well, how loose or tight are you seeing the requirements? You mentioned, you're taking a more conservative approach to leverage. Are you seeing the access to leverage, let's say in that 80% loan to value ratio? Are you seeing flexibility there and you're going on the more conservative side of things, or what's your thought on that in terms of marketplace?
Yeah, we can go much higher on the LTV, much higher. I mean, we can go 70% plus in most cases, but we choose lower leverage just because we don't think the risk-adjusted benefit warrants increasing our leverage rate. We're okay putting a little bit more money down, having a larger margin of safety, so on and so forth, which we're fine with because we're long-term holders. We're not trying to churn and turn a return in a short amount of time, like, kind of traditional Wall Street private equity, where it's all about, time as a factor. So for us, we'll take our time, but ultimately we want to see ourselves owning that asset in time. So we want to bring down our risk and our leverage and so on and so forth. But to answer your question, as far as lending, there's actually a really funny, I say funny, it's humorous to me. Whether you or your listeners find it funny, I think you will, but I find it interesting. So recently and I'll not name the institution, but I will say they're a very large, well-known institution. But we've been working with them for a number of months to establish a revolving line of credit. And so when we went to them, they're in the space. They like both storage and mobile home parks, and we have a history with them. They initially said, "Okay, we'll give you a $25 million revolving line of credit," and there's terms associated with it. But the interesting thing is, we and this part that I find funny, we've actually worked for several months to negotiate them down to 10 million. we didn't want 25 million, we wanted 10, and the negotiation was, no, we want to give you 25, and no, we want 10. So we finally got to the point where, and it's not yet done, we still have work to do, but we have successfully negotiated down the revolving line of credit to 10 million because we thought more than that was just not needed, unnecessary. But I think that kind of illustrates the nature of the question, which is to say, lending today is not that big of a challenge. The key is the viability of the asset and the experience of the management team. So the management team is actually pretty important. We get heavily scrutinized every time we obtain financing. If we didn't have the experience that we had, it may be far more difficult. But beyond, if you have a viable asset and an experienced management team, there's generally many lenders looking to provide debt on the assets you're looking to acquire. So it's a pretty competitive marketplace, competitive for our business.
Okay, that makes sense. And one of the things that a lot of people have been asking me about, I've got a lot of emails about this recently. There has been a relatively historically significant development in self-storage. You mentioned it earlier in two markets. Mm-hmm. There's a chart that I saw recently, which I will link to in the show notes page, which shows 2016, 2017, basically historic yields when it comes to development. Now, a lot of this is because of the fact that there was basically no development for several years as the square footage was, absolved into the marketplace after 2008. But what are your thoughts on this development that's taking place? Is this going to kill the self-storage market? What's taking place in that?
No, I think markets do what markets do. They typically drive down the highway by hitting the guardrails. All markets generally do that because people are involved and people are people. So there's a whole discussion on the psychology of why those things happen. But at the end of the day, to your point, there was a lot of pent up demand coming out of 2008 to 2010. That demand consumed available space. Rental rates went up to the point where it was significantly cheaper to build than to buy, which necessitated the building process. And, we expect it's been pretty public and widely available in terms of people who have talked about this. Especially, I think the New York Times a couple of years ago even published something about the crush of new supply coming online in 2017, 2018. So we expect most of that supply to come online this year, the new development projects to come online. 2019, those really start to fall off. So not much. We see it as a reduced risk in 2019. But at the end of the day, it was brought about because the ability to build was, you could build for cheaper than you can buy. And there's pros and cons to that, as you mentioned earlier. There's risks you're taking, for doing that, but it seems to make sense on paper.
Additionally, I wanted to add that of that development, which is really significant, about 40% of all the development is actually in 5 markets. Dallas, Miami, New York, Atlanta, and Houston. Yeah. And this is something that really needs to be considered. These are highly prime markets where the metrics are significantly different. Now, I really like being 35 minutes outside of a market like, let's say, you mentioned Melbourne, for example. Melbourne is more of a market that I want to be involved in, but let's say 45 minutes outside of Austin, 45 minutes outside of Denver. That's kind of my quasi-tertiary type of strategy. Denver is a market that I know you're extremely bullish on. That has had an incredible price run recently, caused by demand, caused by job growth. What are your thoughts on Denver as a whole and the historically significant increase in prices that they've experienced over the last 10 years or so?
Yeah, so a lot of the markets you mentioned in terms of 40%, that 40% number, the Dallas, Dallas, Houston, Atlanta, those are good markets, and we'd look in those markets. But as it pertains to Denver, Denver is on fire. A lot of pretty significant population growth, especially kind of the millennial population. It's a trendy place to be. And right now, I think the latest net numbers that I saw was there's roughly 18,000 people a month on a net basis moving to Denver. And so there's just massive growth. They can't build apartment complexes quick enough. And so we've been in Denver for a long time. I say we as the entirety of the team. We have quite a few projects that we've certain members of the team have owned for, I think more than 30 years in Denver, still own, and we really are bullish long-term on Denver. And so 2 markets more recently, we've built in submarkets of Denver's Parker, which is southeast of Denver. It's about, to your point, it's about, depending on traffic, like everything, it could be call it a 20-minute drive, 25-minute drive from downtown Denver. But Parker, we opened that. We got our CO, I believe, in early March. We underwrote that asset to be able to rent 1 unit a day. And right now I think last I looked, we're at 200 and some odd units. We're almost 40% occupied on that project. We're, call it 2.5 times ahead of our projections. To illustrate some of the demand, we were moderate on our projections, but we way underestimated the current demand in that market.
Wow.
So that market, that project in 3-4 months is almost 40% occupied, which is great. So that's very much ahead of schedule. It's a market we like. We're very bullish on Parker and obviously Denver at large. Another market we're building in, we should be complete with this project sometime in October, is in Aurora, Colorado, which is, call it 15 minutes up the road from Parker. And as it pertains to downtown Denver, it's basically due east, right beneath kind of the airport area. But Aurora is, booming. We actually just saw I was in Denver last week, right next to the development site, right next to our storage facility, which is on a main really great area, high density. There's a new apartment complex that's now being built right next to it, touching the property line. So, and that was new. We didn't know that was going in when we built the facility. So that's great. So the point is, there's a ton of people moving. The areas are getting more and more dense as people want to live close to downtown Denver as possible. And that density creates opportunity, especially for storage.
What are you developing to in terms of cap rate? What's the ideal cap rate that you would see that would be willing to go through that development risk?
We don't develop to a cap rate per se, but I think to answer the question using some metric, to buy today, we're buying at about call it 100. Earlier I said 120 a foot, could be 130, 140. It's project by project, but let's say 120. But if you can build all in for 80 a foot, all in including your lease up costs, finance, the total stack, well then it might make sense.
Okay.
But right now we're building, on average, and that was an illustration, but right now we're building roughly $100 to $110 a foot, and that's all in. That's lease up, costs or the negative, the negative that you're running until you fully lease it up. That's the interest on the construction loan. That's carrying costs. That's the land cost. That's all in, but generally $100 a foot.
Okay, so maybe a 20% discount to the typical purchase of a more value add focused opportunity.
Correct, and we do it on a portfolio basis. So we may buy 8, and this is a rough number, but we may buy 6 to 8 income generating assets, existing projects, and then to kind of juice the back end component or the capital appreciation component, we may throw in 1 or 2 development deals, because then the portfolio can take that risk, almost like what you described earlier on adding on to an existing project. We can get some benefit there. So, but yes, to your point.
You mentioned the Denver market. It's kind of a hip place to live. A lot of millennials living there. There's a lot of people that are proponents of the thesis that millennials aren't really interested in buying things, including homes or, non-perishable goods, and therefore maybe won't make the best self-storage tenants. What are your thoughts on that? Do you see that happening in the Denver market? Do you view that as a risk?
Well, I always, I hear it all the time. And my wife and I are both we're early in the population of millennials. So I think I'm millennial by Wikipedia's definition by 2 months, and my wife by several years. But the point is, I keep hearing this, that, millennials don't buy things. And in that case, why is Amazon $1,000 a share, right?
Yep.
Why are we buying Amazon? If the future is not consumptive, that's bullish towards Amazon, or I should say bearish towards Amazon, bearish towards GDP growth, which obviously Buffett and everybody else is very positive in the long run. So at the end of the day, I haven't seen many millennials recently walking around in sackcloth with no technology. I can't remember one, although, that's even debatable. But here's, I'll give you something more recent. I've heard this too in other asset classes, meaning millennials want smaller spaces, they rent, they don't buy, they're not consumptive, all of these things. Here's some things that are starting to show themselves. There was an article, I think, last month, and I believe it was in the New York Times or the Wall Street Journal. Sorry, I don't have it off the top of my head. But basically, what it was saying is the Dallas, for apartment complexes, Dallas and Seattle have, between 2012 and call it 2016, really, the growth rate, the rental rates were off the charts. But that's actually now gone flat, primarily because millennials are actually moving into houses in droves. They're buying houses. They're getting married. They're starting to have kids. And as much as, in 2015 and 16, the message was millennials they'll get married later in life. They'll live in apartments. They don't want home ownership. That's actually not it's starting to happen, which means they're starting to buy homes and they're starting to have families and kind of go more the traditional route. But at the end of the day, do millennials like smaller spaces? Are they comfortable with smaller spaces? There's a lot of data that shows yes, that that's the case. On the opposite end of the spectrum, you have baby boomers and members of the greatest generation who also are downsizing en masse. And at the end of the day, if you look at consumption, and if consumption is constant and the space by which you have to store your consumption is declining, I can only see that as a benefit towards storage or excess or surplus and the need to store it. And if you throw in rising consumption into the mix, that even adds to that. But to us, we're not seeing any kind of impact that the millennial generation is bringing on at all.
Yeah, 2 points there, and I think you tied that in really well. First of all, I've got some data that, and I'll post in the show notes page as well, that I believe that retail sales actually hit all-time highs recently. So it's really completely counter to the narrative that's coming out there.
Sure.
Similarly, you're hearing a lot of media. The narratives are driven by basically 3 cities: San Francisco, Los Angeles, and New York. Just for people that are listening in other parts of the country, real estate is incredibly expensive in Los Angeles, San Francisco, and New York, and it's all but impossible to buy a property on a median income in those markets. However, if you talk to anyone not in those 3 cities, they all want to buy houses. The vast majority of the population does not live in San Francisco, Los Angeles, and New York. So if you talk to the random person in St. Louis, their goal is to buy a property. And they're usually, if they're making a median income, for example, they are very likely to be able to do that. It's remarkable the difference between the narrative and the actual data out there, which is kind of along that same point with you that you're just making.
Yeah. Agreed.
One last question. So I'm very bullish in the self-storage sector. I've been talking about it for quite some time. What do you see as the risks of the asset class? We talked about development. We talked about interest rates. We talked about demand. What are you seeing in terms of really turning that market, causing some challenges for the market?
I think from a couple different points, there's nothing structurally, that I see to the market, a structural risk. And obviously technology innovation, you're always looking for, disruptions that, might be lingering or looming on the horizon or, ways that you can bring in technology into the business. There's a lot of ways that's being done today in a way that does create risk. We have a couple projects that are near to storage facilities that use kind of the kiosk model. And we love we love operating near kiosk models because in one of the properties in particular, the rate that they're charging is so far off market. There's some kind of glitch in their data, yet the whole project's operating as if it's true because there's no humans involved. And so we love that. So there's just a lot of faith you're putting on a machine, and sometimes it takes that. So that's a risk. But at the end of the day, there's a couple of bigger risks specific to operating in the asset class. And one is, today there's a lot of capital floating around in the market. So I think there's a inclination or a propensity to just deploy capital rather than to execute and implement a model. So that's the question. Are you buying an asset to implement a model with a specific outcome in mind, or are you looking to deploy capital almost for its own sake? And I see, I can't give you clear examples because it's not always that clear, but I sense that some might be doing the latter rather than the former, which to me is a risk. But to me, at the end of the day, management is one of the biggest risks. Can you manage an asset? But you referenced this earlier. It's a simple business. Baking bread is very simple. Yet we all probably gravitate to the baker who does things in a very creative way and in a way he would say is very complex. And we like that product. So to me, can we manage a simple business in a way that produces more value than the sum of its parts? And so some of the ways we do this, just to give you a couple of examples, and they're pretty simple, but for us, it's all about experience. Our standard is Disneyland clean. If you go to any of our projects, that's our standard. Our managers know it. You can ask any of our managers. The standard is Disneyland clean. So, when you come into any one of our storage facilities, if you're storing stuff, our managers will find you in a golf cart and offer you free bottles of water. One, it's nice to get bottles of water when you may be sweating or thirsty. And two, it's their way to, in a non-invasive way, come up to you, see that you're there for positive reasons, and you don't take it as them inspecting your activity, rather they're delivering a bottle of water. The other thing we do quite well is we use merchandise as a tool for a relationship. So we have the merchandise, we have the boxes, the bubble wrap, the locks, the box cutters. We have all of that in the office. It's all branded, looks great, and that's very important. The role in the merchandise is, one, of course, we sell things, but two, if you rent a locker from us, it's go over to the wall and pick out a lock or pick up, two things, and it's on us. Thanks for choosing. Mini U is the brand we operate under. We also have a truck, a complimentary truck if you move in. It's a branded truck. When you move in, you get a truck. If you move out, you have to rent it, of course.
Right.
That it's a free use of the truck to move in. So we do a lot of things to bring people in, treat them well. We provide a clean, safe place to store their things. And that, that's treated us well in the past. We think it'll continue. But I think at the end of the day, the risks are deploying capital today for the sake of itself and not being as honed as a management team as is required.
Awesome. Well, I know we could go back and forth on this topic and many others. I'm going to have you on because I do have a million more questions about self-storage and otherwise. But before we run, Ryan, I really appreciate it. And if you would do me a favor and just let the listeners know how they can get in touch with you, how they can learn more about your firm and what you guys do.
Sure, absolutely. And I appreciate the time. And before you reach out to me, definitely get to know Hunter. He's a star in this space. And I've had the privilege of knowing him and watching him and the attentiveness he gives his art and his craft. And it's pretty impressive. Where a lot of people talk, Hunter's actually out in market, kicking tires, visiting properties, sweating alongside of us. And it's impressive to watch. So
thanks for the shout
definitely
out.
He can put you in touch with us. And, our website's elevationcapitalgroup.com. Our contact information's there, email and the like. So feel free to visit it. Let us know how we can help.
Awesome. Well, Ryan, I appreciate the kind words and thanks again.
Yeah, you bet. Thanks for the time.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.